Imagine this. You issue shares to raise capital, and a few years later, you spend money to buy back those very same shares. Sounds crazy? Welcome to the world of share buybacks, one of the most contradictory yet popular tools in finance. Today we'll explore what's behind share buybacks and who really benefits. Chapter 1. What is a share buyback? A share buyback means a company repurchases its own shares from the market. This usually happens via the stock exchange, though sometimes shares are bought directly from major shareholders. The repurchased shares typically disappear from circulation. They're either canceled or held in the company's treasury, meaning they're no longer part of the free float, the portion of shares available for public trading. Chapter 2. Why do companies do this? It sounds clever, but why do companies use this strategy at all? First, it's a signal. When a company buys back its own shares, it's saying, "We believe our stock is undervalued. We're investing in ourselves." This is meant to build trust, especially among shareholders. But it's not just symbolic. There's a very real accounting trick behind it. After a buyback, fewer shares are in circulation. The company's total profit remains the same. And that leads to a highly valued effect in the financial world. Earnings per share, or EPS, goes up. Why? Simple math. The company's profit is spread across fewer shares. Imagine a company earns $1 million and has 1 million shares outstanding. That's $1 profit per share. Now, if 200,000 shares are bought back and removed from circulation, only 800,000 remain. The profit is still $1 million, but now divided among fewer shares. That results in $1.25 profit per share. The stock suddenly looks more attractive to investors, even though the actual business hasn't changed at all. But that's not all. Return on equity, or ROE, also improves. Here's why. Buybacks reduce equity, since the company spends money that was previously listed as equity on its balance sheet. The profit stays the same. And when you divide the same profit by less equity, the ratio goes up. Example. A company earns $1 million annually and has $10 million in equity. ROE equals $1 million divided by $10 million equals 10%. Now the company spends $2 million to buy back shares. Equity drops to $8 million, but profit remains $1 million. New ROE equals $1 million divided by $8 million equals 12.5%. Result. ROE rises from 10% to 12.5%, even though the company didn't earn a single euro more. Both metrics, EPS and ROE, look better after a buyback, even if the company's operations haven't improved at all. And that's exactly what makes buybacks so attractive to management and investors who focus heavily on these figures. At the same time, buybacks are a flexible way to return money to shareholders. Dividends are recurring. Once you start paying, you're often expected to continue. Buybacks, on the other hand, are one-off. You can start them and stop them if needed. That gives management plenty of room to maneuver. And yes, there's a less noble reason too. In many companies, executive compensation is tied to the stock price, EPS, or even ROE. When these metrics rise, even artificially through buybacks, bonuses often follow. In short, buybacks can boost the stock price, polish key metrics, please shareholders, and make management happy. Chapter 3. The downsides. As appealing as all this sounds, there are serious criticisms, and they deserve attention. Buybacks can make a company shine in the short term, but harm it in the long run, especially when they replace important investments. If money that should go into research, development, or employees is instead used to buy back shares just to inflate the stock price, that's a problem. It gets worse when companies go into debt to fund buybacks. Yes, that really happens. It's like taking out a loan just to look richer. It may impress on paper, but it can lead to a debt trap over time. And let's not forget, the positive impact on the stock price isn't always sustainable. If the company's fundamentals aren't solid, a higher EPS won't help. Eventually, investors realize this was more illusion than substance. Conclusion: share buybacks are a powerful tool, no doubt. Used wisely, they can be fair, reducing share supply, increasing value for existing investors, and signaling confidence. But they're also a double-edged sword. Buybacks can mislead the market, misallocate resources, or simply enrich management. So if you're investing in stocks and hear about a buyback, don't just ask, will the price go up? Ask, why is the company buying back shares? And what else could it have done with that money? Because that's where you'll find out whether a buyback is truly smart, or just for show. We hope this video helped explain and illustrate the topic. If you enjoyed it, we'd love a thumbs up and a subscription for more economic insights. Thank you for watching, and have a good one.